Okay, hello traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, March 15th. We're about 10 seconds away from the retail sales print here in the United States. Expecting a month-on-month read of negative 0.2%. Strip out auto and gas. You're still looking for a gain of just 0.2. Slight drop off from the previous month. Most importantly, we'll be looking for later in the week. We do get the CPI numbers tomorrow, and obviously today starts the two-day Fed meeting. That being said, survey says negative 0.1%, slightly better than expected. Ex-auto and gas core comes in slightly stronger than expected, although you are seeing some strong downward revisions for the previous month. So not going to be a necessarily strong read here. If anything, it's going to offset any of the stronger than expected prints that we got. PPI also coming in broadly in line with expectations, slightly weaker on the final demand year on year. PPI ex food and energy core, a big one here, pat at 1.2% as expected. So if anything, the downward revisions, guys, not a good sign here on retail sales and the health of the consumer. Like I said, consumer price index later in the week is probably going to be a bigger read. Obviously, tomorrow's tomorrow's FOMC, excuse me, and that's going to be the big player. So we'll keep that in mind. Looking at the dollar index, we did rebound nicely off that confluence support, and we'll go over that in just a moment. Good to see everyone here in the room. Good morning to you all. Joe, Eileen, Permendra, Graham, Hussein, Madad, Mark, a whole lot of people in here today. Some new names as well, so great to see you in the room. A quick reminder for anyone who is new, you have a camera button in the top right-hand corner of your GoToWebinar screen. If you want to take a snapshot of any of the screens or charts that you see presented throughout the webinar, feel free to do that so you can have them for your own reference. All right, so now that the data is out of the way, here's what the broader performance for the dollar looks like so far to start off the session. You're seeing that the dollar is broadly strong against most of its major counterparts. You did see a rally in the yen overnight, 0.91% higher. You saw a split decision in the BOJ last night, 7-2. So certainly some concerns that we won't necessarily continue to see, those aggressive stances to keep monetary policy rather accommodative in Japan. So you did see dollar yen. We'll go over that. That's coming into some near-term support, and we'll want to review that as well. British pound with a little bit of an upset here, down 0.94%. You did see that break on sterling dollar, break that channel support. Sterling yen also broke our bullish invalidation level, shifted the bias lower, and we will go over some other sterling crosses as well. All right, as always, guys, throughout the course of the session, if you have any questions, trade setup specifics you want to discuss, please feel free to post them on the message board, and we'll be more than happy to go over those. Hey, Graham, great to see you, sir. Says, good morning, Michael. Over here in Europe, we have been watching the Trump campaign with fascination. Will those figures affect Mexican wire fence company stock prices? Graham, that's a tough extrapolation, my friend. I really couldn't tell you. I don't. Again, this is just my assumption here, and I'm smiling while I say this to you, Graham. I don't really think that the wall that Mr. Trump is aiming to build is going to be wire fenced. I think it's going to be more concrete. So I don't necessarily know if you'll see a pop in that company, but good question there, Graham. Minho, great to see you, sir. All right, so let's jump right in. Dollar index. So you have the relative performance here for the dollar. Mixed performance on some of the com block, but really the British pound and the yen are the biggest movers on this session. We'll be continuing to follow those crosses, specifically on the yen, sterling yen, Aussie yen are both trades that we've been following, and we will review those in just a moment. Before we do, one other thing I just wanted to highlight real quick, guys, is we were talking about this, and we're going to come back to this a couple of times throughout the course of the week as we head into the FOMC decision, looking at the Fed futures funds rate, okay, and just comparing the two, where we were on Sunday night when we published this to where we are now. You can see that the probability of rate hike has started to climb again on the later part of the year, specifically, most notably on the third quarter. And as those continue to build, should grant some support to the dollar. The biggest thing that we'll be looking for on the back of the decision is a change in these probabilities. And certainly if the Fed futures funds rate starts to factor in higher likelihood or higher probability of a rate hike, you're likely to see the dollar rather well supported. So something that we'll be paying attention to as we get through. Eileen says, by the way, when you get a chance, can you explain what Jamie meant last week when he talked about an uncovered close? I can't remember what pair he was talking about. I think that was on the sterling, Eileen. So let's just jump right into that. Uncovered close is basically when the market gaps lower. The close of the previous day's session is the uncovered close. And Eileen, there's a high likelihood, a higher probability of markets rallying in to cover that close, it's called, before we move off. And that's exactly what sterling did. So let me show you an example of that. Let's jump right in. First things first, let's just go over quickly last night's update. Or let me answer your question here first, Eileen. I might as well do that. Here's sterling dollar. We went over the dollar index. I just want to cover that real quick on the near term. So again, dollar index coming off that near term confluence support. We covered this on the 13th. Big region. You got the 50% retracement. You got basic long-standing former channel resistance, turn support. Here we are again. Okay. And the 50% retracement of the advance off of that May low, from last year. So you're seeing some upside. The 200-day moving average is right here, 12,053. Just ahead of that, 12,042. You also have just a basic swing low. Here's what it looks like on the 30-minute chart. Okay, and here's what we looked like last night. So we were holding just below this resistance. We were talking about the upside probability breach higher, targeting the upper median line parallel, 12,042. It's exactly what you got, right into 12,042. And here we are moving off again. If we clear this channel resistance, that would be the mark for a much more substantiated dollar rebound. Remember, we're coming off of a big support confluence that we just looked at on the daily chart. So to see this upside, find some resistance here is welcoming. You're not really getting a turnover in momentum just yet, but long side is at risk while below that 12,042 mark. Remember that 200-day moving average is just higher. One other thing I just want to note is there's that swing low, and that's all that level of resistance is alongside basic channel resistance. All right, so on the pullback here, again, look for some near-term support near 12,014. And I would have to say a break below that swing low that you made in US trade yesterday is really what would shift the focus back to the downside here for the dollar index. So we'll call this low here, 12,007, let's call it, as our near-term bullish invalidation level for the index. Any questions on the dollar index, both on the daily and the 30-minute? Again, we're working on the presumption, as we noted on Sunday, that we're basically looking for some support early in the week. And that rebound higher inevitably would offer some nice short entries later in the week. Keep in mind, again, the event risk that we have on tap has the likelihood and probability of really shifting some strong dollar swings in either direction. So we just want to make sure that we're keeping the powder dry. If we do get that stretch into resistance on FOMC, depending on what the commentary is from Yellen, might offer a nice opportunity to get back on the short side. That being said, we'll have to see how price action pans out today with the index coming right off confluence resistance. Pretty clean. Give me one sec. I just want to check something out. Okay, I'm too early to tell. Okay, so that is the dollar index on where we stand sort of right now. Here's the British pound, and this is your question, Eileen. Here's the British pound look like last night. We had an upside bias last week after we cleared this 42 region of support, of resistance, former support. The rally came into a very, very nice spot. You had the basic median line off the lows from January. You had basic channel resistance. This is just a mirror, okay? Or a parallel of basic trendline support. You saw both those confluence there on Friday. You saw a really nice kickback. To start off the week, here's what sterling looks like. Let me get back to the daily chart real quick. Okay, so that 43.98 region that you're looking at right here, that's the uncovered close, Eileen. And that happened right here on the 19th of February. You can see that. Let me just zoom it in for you. You can see that session we closed at 43.89, and the previous session we gapped all the way down to here. This is where the market opened. And the propensity to fill those gaps, meaning to extend into that close level, is high. And a lot of times you'll find resistance there as well after you've made a downside stretch like that. So that's exactly what happened. We saw a downside stretch. The uncovered close was 43.98. Just above that, you had the median line off that January low. You spiked right into that on Friday before turning over abruptly. Eileen, does that make sense? Does that clear up the question? So an uncovered close is simply when you make a gap in price. If the market hasn't filled that gap, that remains uncovered until the market does. So as of Friday, we've now covered that gap close. Does that make sense? Eileen says, oh, really interesting. Yes, thanks for the details. Never heard that term before. Well, now you have. It can be very, very helpful, especially when you get breakaway gaps like this. A lot of times in the market gaps like this on the open, your initial sort of response is to want to take a long and fill that gap, because a lot of times on the Sunday open, when you get those gaps, like you did here, for example, okay, here's a gap on a Sunday, here's your Friday close, you gapped into a Sunday open. The open there was 149.03. We rallied right into the close, 149.22, before we moved off. And you see these happen a lot on the Sunday opens. If you don't get that gap filled right away, when the market reverses and starts to head back towards that gap, that's going to be your inherent limit or your inherent target. It's just a phenomenon that tends to happen over and over in markets. So yes, sterling did fill the uncovered gap at 143.98. You saw that tag of the median line we're pulling off. Here's what the intraday chart looks like. Here's what we looked like last night. So I was looking for long triggers into this region, no doubt about it. Former resistance turned support. The 38.2, basic retracement of the advance. And 142.14 actually represents the weekly open from last week, which you saw some really nice pivots on. Add to that basic trend line or channel support, and add to that former trend line resistance. Should have offered support, but it broke through. So this was our bullish invalidation level. If you were playing the shorts, this is where we were looking to take those limits and look for long triggers. We never got the long trigger. And not only did we get the break, but we also got the break in momentum. And that's the first sub 30 break you saw since back here in late February. And obviously on the break of 30 there, it was just the onset of a continuation to the downside. So for me, near term, yes, from here, you could see some upside back up into 42.05, 42.14. As long as we stay below this region, the risk is for further declines in the British pound. Now, just to clear some things up, I know some of you might be saying, well, Mike, you started off the week on Sunday saying that you're looking for broad dollar support. Why would you be looking for sterling to hold support? Well, we can't take that as a blanket statement across the board, guys. And the bottom line is, the end of the day, if you look at the sterling dollar on a daily chart, the advance that we got last week or last month into the close, like we said early in the month, guys, we're working on the basis that this may be a little bit more of a concrete, significant low for the pound. Again, I'll bring your attention to the radical divergence, really strong divergence that you saw in price, both in the lows for January and February, followed by that 3-point trigger break to the upside, has me looking higher. So I'm not going to put it outside the realm of possibility. Am I going to start pressing the longs? No way. I'll be looking for a close back above this region or a little bit more of a significant momentum shift, to validate the turn in price. But certainly at this point, below 42, guys, you're at risk for further declines for the sterling. So we'll leave it on the radar chart for now. The best play on this was the short into 42. Now that you're below that region, again, I wouldn't go chasing shorts from here. You're likely to see a pop into this region. You might actually get another opportunity to get short off this if we pop up and find some resistance and a short trigger there. But at the end of the day, we need to close above this region again to validate continuation of the broader upslope from the lows. So Eileen, I hope that answered your question on the uncovered gap for the sterling. Guys, if you have any other pound questions, do feel free to throw them out. Keep in mind, obviously, we do have the BOE on tap for the 17th, which is Thursday. Okay, it's going to be on the back of the Fed interest rate decision, which is going to be tomorrow. The two-day FOMC policy meeting starts today, guys. And the presser and the release of the quarterly projections and everything comes out tomorrow, 2 o'clock. Eileen says, yep, and thanks for the pound notes. Hey, you're more than welcome on that. Okay, just to, again, emphasize the data coming up for the pound over the next few days, you do have those unemployment numbers, ILO. Those are tomorrow morning. We'll be looking at those with great interest. You saw a big drag down last month of 14.8 thousand jobs. We're looking for a contraction in negative 0.1, or contraction of 9.1 rather, thousand. These are jobless claims. So again, the bigger, the better. 2.2 is the claimant count rate. We're expecting that to hold broadly even. The ILO 3-month unemployment rate is really the headline one that you see for the UK, also expected to hold at 5.1%. And again, just a quick preview also of the Okay, sorry about that, guys. I think we have an audio gap again. All right. Any other questions on the British pound before we move off? Yeah, thanks, Brian. David, appreciate the heads up, guys. All right, moving right along. That was the British pound. Again, remember, guys, on the radar charts, if there is a link above, that's just a link to the previous update that we've given. So certainly if you want to check out the daily charts, or if you want to check out any of the other metrics, feel free to click on those links to review those previous trades. So last up on tap from last night's radar chart was the Aussie dollar, and another one that played out really well, actually. So here's what Aussie dollar looks like on the daily chart. If you remember from the update, our base case scenario was to look for a push lower in the Aussie dollar. Let me see what that update looked like. There it is. We're basically on the lookout for a pullback here, selling rallies with a breach or the break below 74.89, targeting subsequent targets at 74.42 and 74.08. So we're coming towards that 74.42 target. Haven't hit it quite yet, but the basic premise here again is the upper median line parallel. Again, we spiked through briefly, but most importantly, bring it into a close. That's about as perfect as a rebound as you get. Okay, and this is why we really like to stress the closes, guys. It's very, very important, and especially when you're trying to ascertain whether you've made a break of the range or not, or a specific trend line or a specific key level. Sometimes just focusing on the close can be very beneficial. So not only did we close right into that region, which gives a little bit more validation of the snapback here, but that 75.90 level actually turns out being the April low day close. Okay, and obviously everyone's going to agree with me, I think, that this was a major pivot in price that held for over a 5-month span before the breakdown here in early July really gave us the drop right into the low. So here we are. Couldn't close above the upper median line parallel. On a stretch basis, on just the high, we came right into it. The high was exactly 75.92, and we came right. Hey guys, I'm so sorry about the sound keeping popping out there. I will look into this again. I know I've already alerted IT a couple of times, but I'll get them on this right away. Where did you lose me? As we were saying in yesterday's update here, the support structure at 74.90, 74.91 was really the focus, and that was really the low that you made for the first day around the clock here, or around the globe rather, for the week. So the initial opening range low. Last night, I did also tweet that we got the minutes from the RBA interest rate decision. The minutes showed that there is a willingness, if inflation remains weak and they see some problems in employment, there is some room for further easing, right? Aussie dollar's at a high, right? That's when you want to start to go with, you don't want to go with buy the rumor, sell the news and all this. You want to kind of go with what the central bank is saying. So on a move like that, where you just kind of think about it logistically from a trader standpoint, the Aussie's been rallying. We just broke a big level a couple of weeks ago. It's been a nice 3-week stint to the upside. You're now getting some commentary from the central bank suggesting that indeed, more easing might be in the pipeline. What does that mean? Well, it means some of those long people or guys who are holding long positions probably going to close out. And that cascade effect will start to give us some downside pressure. And that's exactly what we're seeing here. So you're coming into the primary target right here at 74.42. A downside move even lower, which I do expect, is going to look for a basic 236 retracement of the advance. That's 74.07. More importantly, 73.80, 73.86. You're looking at the 100% extension from the advance off the lows. This is the lows for the year now. And this is just simply the high that you made here in December. Okay, ultimately, on a more substantiated pullback, we would be looking to get long. As it stands right now, downside pressure remains in Aussie. Now, for the Aussie dollar specifically, you have a double whammy event risk heading into today, tomorrow, and the day after. Tomorrow, obviously, the FOMC is going to take central focus on all the dollar crosses, which we'll review today. But the following day, you also get the release of Aussie employment. And the last Aussie employment report was pretty disappointing. Here's what the Aussie data looks like. Okay, so we're looking for the employment change, a gain of 13,000. Last month, we saw a surprise drop of 7.9 thousand. That's been upwardly revised already to 7.5, but certainly we'll be looking at that. Unemployment is widely expected to hold at 6%. More importantly, we'll also be looking at the breakdown in full-time and part-time employment. Last month, again, you saw a big drawdown in part-time employment, in full-time employment, with part-time employment gaining 32,000. So these are the caveats we'll be looking for in the Aussie employment data. Again, that's tomorrow after the FOMC, and certainly has the propensity to really move up and shake some of these Aussie crosses. So any questions on Aussie here? Continue to favor selling rallies while below the weekly opening range high, or that major key level at 75.90, that April low day close from last year. Again, targeting 74.08, and then more critical support at 73.81, 73.86, this region right here. Nah, no good. You're more than welcome. Says thanks for starting over on the Aussie dollar after your audio blip. Makes sense, and for the caution too. You're more than welcome. Yeah, I apologize again, guys, about the audio issue. Let's see what Aussie looks like on the 5-minute. I'm actually pretty interested to see how this looks heading into the U.S. Open. It's all over the place. Yeah, nothing trigger-wise I'd be looking for. In actuality, when you get this kind of price action, I actually think that you're in for a possible nice little rebound here. Maybe check 74.90, 75 as resistance again. You're seeing momentum give you some divergence on this 5-minute chart here. Or actually, these are both 1 minute. That's probably the problem. Oh, even on the 5-minute. So series of lower lows in price on the close basis, series of higher lows. Looks like that trigger already gave out. We'll keep that one in view here as we head into the U.S. Open. 74.40, 74.65 so far is the opening range for U.S. See if that changes. Again, you got 50 pip range here to the upside if it does see a topside sort of cut here, but I'd be cautious heading into the U.S. Open. We'll see how this pans out. All right. So that is Aussie dollar. Moving right along to yesterday's intraday update. Here's what we look like. Sterling yen, big ATR mover. Just want to highlight also, you're getting a 209 pip daily ATR. So you should be looking for about roughly 50, 55 pips per scalp on a big range trade like this. And we did make a break of the near-term bullish invalidation level. That was 162.29/45. Here's what it looks like, or here's what it looked like yesterday on the intraday chart. You had last week's opening range highs, a nice pivot break right there at that 162.45, 162.29. We were coming into it right as support. This was right ahead of the release of the RBA, or excuse me, this is sterling yen. Wrong pair. You're coming right into near-term support here, and that's when we published, look, you're at the bullish invalidation level. I was looking for long triggers here. If we had gotten it, I would have been more than happy to jump in, targeting 63.86. Didn't get any long triggers, and in fact, it broke right down to the downside. If you got a chance to get on the short, it was a beautiful play. Not only did you kind of crack it, but you whipped up real quick right back into the highs to check that swing right here at 62.86, and then slammed right back to the downside again. It was really quick, but if you got it, the initial downside All right, where did I leave off, guys? Right after the sterling yen down target info. Got it. Thanks for that, Eileen. So let me just go back real quick. So once we broke that major key support, the major initial target was right down here. 160.51, 160.50, basically looking at a basic 38.2 retracement, but also a pretty decent pivot in price. Extended that down to 160.35, 36. And you can see we kind of just popped right through that. About to hit that final target right now, 159.40, 159.49. Confluence fib level, but also last week's low. Okay, and what I was noting, hopefully, I think before the mic went out, was the break into oversold territory here. Okay, that's the first break in oversold territory you've seen since early February. And like I said, this was just the onset of a much more larger magnitude decline. So it suggests that we still got some room to the downside here on the sterling. The only caveat I was noting was this basic trendline support. And it looks a little bit cleaner on the daily chart. On the intraday, it looks like we broke, but we're testing that right now. And the swing low that you made from that February 11th, that low comes in at 59.80. Okay, just above that right now as well. I don't know why this is. We're testing that right now. So it's the only thing that has me hesitant to do anything right here with sterling yen. It is a wider range ATR, very similar to what we're expecting in dollar yen. You might have seen Jamie just earlier today, excuse me, might have seen Jamie just earlier today tweet a chart on dollar yen. Here's what that looks on the daily chart. Very similar, right? Basic trendline support off the lows. Jamie has this as a pitch, whatever you want to look at it. It's the same median line structure. It has us testing support right now. Okay, and the ongoing divergence was never refuted. So you still have that divergence signal that suggests you might have some upside here in dollar yen. 30-minute chart. It's broadly been in this range now for a third week between 112.36 and that 114.40 level. And although the momentum signature doesn't look pretty healthy, what does that 160 indicate for dollar yen? I'm not sure what you mean. 160 on the daily? I'm still not sure which line you're looking at there, Eileen. Oh, sterling yen. I'm so sorry. Yeah, let me get that back for you. Sterling yen, sterling yen. So this level right here, just below 159 or so? Yeah, this is just the swing low that you made for that February 11th drop down. Okay? Basically, that's all that is. Just a basic swing low, and also you have a nice pivot in price here, and it coincides with that channel support, which is what I was looking at. So we'll see for sterling yen. The thing is with sterling yen is that you still have the BOE on tap, and while I don't really expect to get anything major, I'm not a fundy guy, and I've been talking with a lot of fundy guys here in New York on expectations for the BOE, and some of them seem to think, and again, guys, this is all conjecture, I just want to throw it out there, but some of them seem to think we might actually get a little bit more of a hawkish tone with what's going on after, basically saying after the referendum, everything is going to be happy-go-lucky or whatever. Listen, we can't pre-play the interest rate decision, and unlike NFPs or unemployment or inflation, we don't really have any projections or gauges to help us gauge what the market is expecting. So with the BOE, we'll just have to play that by ear. So on the sterling crosses, I'm hoping a little bit more of a hawkish tone. I am hoping that we'll see some sterling support because I do still think that the broader focus is to the upside. That being said, near term, watch this 59.50 level on sterling yen as near term support. The bullish invalidation level, by the way, for the broader ascent here for me near term is going to be like 158.50, this high. It's a 618 extension off the low, but more importantly, it also converges on that sliding parallel you see there in orange. Okay, over the next few days. So kind of got a good idea of what I want to do if sterling completely breaks down from here. Any questions on sterling yen, dollar yen? Next up on tap, we're going to cover Aussie yen. And here's what Aussie yen looked like yesterday. Okay, another pair that came into a beautiful confluence resistance early in the week. We noted a downside bias, but we were looking for support to hold near 84.72. Obviously, that didn't happen. 84.72, for your reference, is the low day close from 2015, specifically what we made on August 24th on that drop down day in risk, and broader equity markets also saw a huge day. In any event, that close was coinciding dead on with a median line parallel. And if we broke below this, that immediate downside bias would be carried over into the latter part of the week. Here's what Aussie yen looks like first on the daily. Okay. And again, there's that confluence support that I was looking for a hold at. You didn't get it, so the downside bias remains. Remember, the focus turned lower at start off the week, not only in the count of where we were in price, but also on the fact that we were at confluence resistance as momentum was testing 60. So if we go back to the reports, guys, from the 13th, this was Sunday. Oh, it was actually on the radar charts. So if we go back to the radar chart on Sunday for Aussie yen, here's what we were looking at. And we suggested, look, this thing is ready for a pullback from here. You got a 618 retracement. This is of the December-January range. You have the highs swings from late January, from early February. You had the median line coming right off the lows, all coinciding right here as momentum was coming into 60. So inherently, you're looking for some kickback. Now that the reversal has taken us through support, you're going to take a little bit more of a neutral stance from here. Here's what Aussie yen looks like on the intraday chart. There's a 30-minute. And here's what we looked like last night. Okay, so you were holding right above that 100-day moving average. That 100-day moving average was coming right in line with basic trendline support off the lows. And this was going to be our bullish invalidation level, again at 84.72, that August low day close from last year. So I don't need to walk you through this step by step. Basically, you broke 40 in momentum. That kind of clears out the topside momentum signature. And again, we broke through not only the 100-day moving average, but also basic trendline support and that August low day close. So still looking lower from here. You could get a pop back up into 84.72 to start off the session as resistance, but you're basically looking for a run into last week's swing low. Just ahead of that, you have 83.47, which, if I'm not mistaken, is just a pivot in price. More importantly, that 82.83 level, okay, into the 83 handle, essentially. Nice pivot in price. 618 extension has offered some resistance before, and a key 618 retracement a little bit lower from where we are now. All right. Ultimately, like I said, again, I would be looking to get long on a more substantiated pullback. Bring your attention to a basic trendline resistance that we broke earlier in the month. Could be a simple case of break of resistance, check as support, and continue on our merry way. But certainly the risk is for a little bit more of a drawdown here in Aussie yen. Any questions on Aussie yen? Okay, so that's British pound, that's sterling yen. We covered dollar index. Okay, let's take a run through really quick on the dollar crosses. Obviously, the big major event risk this week is all dollar related. So let's take a quick swing through. So first things first, euro dollar. Here's what the euro looks like first on the daily chart. And if you've seen or if you've noticed that there's been a lack of updates on the intraday charts for the euro, that's intentional. I don't really like to get involved in near-term scalping on pairs that have huge, massive swing days like this. I feel like there's a lot of reverberation, just kind of a lot of noise as markets sort of, I like to call it the hangover effect, right? Where intraday price action isn't that clear after a major move like this. And where this thing bottomed out, guys, was all the validation that we need for the bias that we've been really trying to aggressively hold, which is, the rally towards 1250. So again, not to backtrack, but what we did on what we did on Thursday there was pretty huge. Okay, again, the broader structure off the highs that we made from May and August of last year. That median line has offered some really nice plays. Again, stress the closes. And this decline came into the yearly open at 108.72, confluence with that median line before rocketing to a new high on the same session. Okay, so I'm still looking broadly. I want to see some more support here in the euro. That being said, can't put out the possibility of a more corrective stance if we break this median line. So here's the near-term approach I've been working with since the start of the week. This is just a basic median line formation off of the lows for the month. You can see the median line itself almost catching that low that we made yesterday before reversing right back into near-term resistance. So I don't really have any conviction scalp targets on this, guys. I just want to throw that out there, but I would be looking for support. And again, I do like euro to the upside while above 10.45. That hasn't changed. It's been like the same level for 3 weeks now. We were waiting for the break last week. We finally got it. This is what in my mind would validate a downside break. That being said, I'm still looking for long triggers. Look on the momentum signature. Despite the decline that you've seen since the start of the week, brief spikes below 40. And here's your 40 hold, a little bit more conviction. 40 hold, a little bit more conviction. This is your highest RSI indicator read since essentially that Monday-Sunday open. So looking for price action to really give us a little bit more of a conviction reversal. Do like the euro to the upside. Again, on this one, I'll have to play it just on a basic opening range strat. So if we clear 111.72, 111.73 to the upside, that's a break of the objective opening range for the week and would have me looking higher, targeting 112.17. And then 112.50, 112.60 is really, really big. It's still the level I've been waiting for. That's the level we were waiting for on this stretch that we just missed. Huge region. Okay, you got the 618 extension, 618 retracement, off of the highs from August, just a basic 618 retracement. You got the 100% extension off the lows, a 764 off the October high, and the reversal day close comes in right below that. Okay, actually the reversal day close comes in exactly at 1248. So big region of resistance backed up very closely by the upper median line parallel, and I do think we finally do get the stretch at some point. Okay, could be a scenario, again, this is just conjecture, but again, could be a scenario where you see the FOMC come out with a little bit more of a hawkish tone before they start to pad it in the press conference, where you see sort of a major spike in the dollar, giving, or a little major quick pullback in the dollar, rather, giving this thing a spike into resistance before the dollar finds some support and then starts to build. But big region of resistance, near-term bullish invalidations, pretty close at 1050. Keep in mind you have the 200-day moving average in there and the 618 extension off the low. Any questions on euro? And again, it looks like if we hold this low today, it looks like you might have just a simple, pretty clean opening range here for the week. We'll have to see how the US Open looks like. Next up on tap, dollar CAD. Here's what dollar CAD looks like. First on the daily, we do have it coming into resistance today. Basic channel or basic trendline resistance off of the yearly high. More importantly, this huge region that we were talking about earlier in the month. This is a longer dated 618 retracement of the decline off the highs. That dashed line that you see there is simply the high day close for September, which was a big region before the breakout we saw late last year in December. Same region now coming as resistance. So again, 134.20, 134.60, a little bit bigger of a range, but it's been a one-way trade, guys. So we really need to be mindful of what dollar CAD does from here. This is the breakout zone. Okay, this is sort of the level we need to clear to validate the reversal that we're seeing in dollar CAD. Price action near term has not been all that inspiring, although we have seen the highest break into overbought territory. I guess since the highs, if I'm not mistaken. Well, not quite the highs. I stand corrected. Since the highs. Okay, so that's a big deal. That's a big deal. And certainly since the start of the week, we haven't even seen a 40 test. So I do like a broader turn here. Again, watch that resistance. If the dollar index finally does make that push through channel resistance, I think that's all we would need to validate a little bit more of an upside approach here for dollar CAD. Again, if we do get that low basing, guys, we'll have to reassess the levels. So I don't want you guys stressing the levels you see right here just yet. More so, basic trendline resistance off the high and the September high day close and that 34.60 level. Okay, so once we clear this region, tack on a quick retracement, and we'll look to play those topside retracement levels. But first things first, you really need to clear this to validate more of a significant turn in price here. Any questions on dollar CAD before we move off? A quick reminder, as far as the CAD data is concerned, you do have some stuff on tap later this week as well. Most notably, I guess, would be the CPI numbers that you get on the 18th here. We're expecting CPI to show a stronger print year on year, but softer month on month. We'll be looking more at the core numbers, which are expected to hold at 2% year on year, and that's really going to be the headline figure heading into Friday's trade session. Good question. Would you be looking lower at all in dollar CAD since daily and 30-minute seem at resistance, even though RSI is showing more longs? So the immediate focus heading into the US Open, I think you missed that play, Eileen. If anything, that play for me would have been off of basic trendline resistance. I'm not really looking to play a short from here. Well, let me take that back. Here's what I want to say. Again, we take every trade on its own merits, right, Eileen? We don't want to make sort of broader assumptions. Here's your basic trigger support. Here's a basic retracement off the lows. What's up? Yeah, against that resistance would have been the best trigger there. Look, if we come into the U.S. Open, Eileen, and we get some short triggers, you can take them. But remember, we always say it's a counter trend trade for the daily bias. So if you're gonna trade that, again, I have no problems. I've had beautiful, really constructive days on days where I'm just fading the broader bias. But we're trading half leverage, a quarter leverage, because again, when we're trading with the trend of the session or with the broader bias, a breakout, a continuation, a breakthrough gives you the opportunity to sit out those winners and keep in the trade. Whereas if we're trading counter trend, the market starts to move against us or breaks the opening range high for the session, you gotta dip out. So we want to make sure that we're trading lighter on days when we're trading against the daily trend. That being said, personally, again, Michael Boutros, Eileen, I'd still be looking for a pullback here to offer some long exposure. I really don't know if I want to fight the downside, especially with what we're seeing in the dollar index, right? That's coming off support. It's coming off a big support level. And if we look at the intraday chart for the dollar index, yeah, we just came off that resistance into near-term support. So I don't necessarily want to try to fight that, right? Our base case scenario, like we said, is for a move higher and some broader support this week in the dollar. So just something to keep in your mind. I don't think that you're off too much, Eileen, by wanting to look at a possible short trade in dollar CAD. But the more sensible thing to do and just a near-term approach is, well, let's just see if we get this pullback to get back on the long side, or if we get a break above, look for the pullback to get back long. So if we get a break through this resistance or this trend line resistance, I'd be looking for that pullback to take a long against that low, trying to play a little bit more of a substantiated breakout towards that 3460. Does that make sense? Eileen says, okay, it's against the main trend for shorts. Makes better sense, and see the earlier triggers that I missed. Oil was rallying a bit, but yesterday falling again. So that's why I was thinking about the shorts on dollar CAD. I don't blame you. A lot of people are going to be following that trade. Now that you've mentioned it, Crude, everyone here, I don't know if you guys came to the webinar yesterday on Daily Effects. Do remember, it's a public webinar for everyone, guys. So it's essentially the first webinar of the week for SB as well. We went over Crude yesterday. We got that break, guys. Excuse me. We got that break. Key resistance, 38.31, 38.47. No one should be surprised to see that here. We talked about that level at length last week as the trade really tried to break through. Here's the pullback on the reversal session yesterday. We didn't quite close below that basic trend line support, but certainly we did close below the median line. Okay, and the pullback here progressing right into the 100-day moving average, where we're finding some support here near 36.19. Key support is still 35.30, 35.50, this region right here. Bullish invalidation would need to be a break back below that upper median line parallel. I don't think you get it. I do think you find some support lower from here near 35.30, or the parallel comes in now about 34.50 rather. So looking for some support, 35.50, 35.30, or 34.50, 34.30 for some possible long entries here in Crude. A break below this, like I said, would suggest a much deeper corrections at hand for the Crude trade. Questions on dollar CAD or Crude? We covered dollar yen briefly. And dollar Swiss. Dollar Swiss, I just want to show you the daily chart. Intraday dollar Swiss is ugly. Okay, super ugly. I don't know what to do with this, if anything. The only thing I wanted to highlight is if we're working with this median line formation off the highs, which has offered some decent pivots. I'm not too crazy about it now, but if we're working off that assumption, excuse me, the opening range high was Okay. Thanks. The opening range for the dollar Swiss comments, Eileen, saying that for a trade like this, I kind of just want to let the opening range pan out. Especially if you're just looking at this on the daily chart, I either want to see a concrete break below this lows, in which case you still have the 200-day moving average to deal with, or a more assertive break through the opening range high, in which case you'd start to look for a run back towards that 100-day moving average, back towards that key resistance, basically just above parity 30. Don't forget, 10031 is the yearly open. Okay, and that tends to be, again, big levels that we want to pay attention to. So at odds with dollar Swiss, I don't really have a strong conviction bias on a scalp here, guys, but I just did want to highlight the key levels that we want to be paying attention to, and specifically as we open the week, I think the opening range is starting to become a little bit more clean here. So I want to see a break above this, pull back, try to get long against today's opening range low, or if we do see a downside break, I'm actually not interested in playing it on the downside. You have too much there for me to really get excited. That 200 days typically not something that'll keep me out of a trade, but if you take into account that this specific 200-day moving average on this specific pair has been really, really paramount. It's caught some serious pivots in price. Resistance, support, sail through on both sides, but there's support again, support. It's right there. Not too far off where the opening range low is. So maybe not on the primary radar chart, but something we'll be looking at. And again, if something does pan out with price action, I'll give you an update on that later today. All right, guys, those are all the pairs that I am sort of focused on heading into tomorrow's all-important interest rate decision. Again, we'll have a nice discussion here ahead of that tomorrow morning. I do want to jump into your questions right now. Craig says, thoughts on sterling Kiwi and chart so I can take some snapshots if you get a chance. Absolutely. Here's sterling Kiwi, man. So a trade I think is going to give us much more clean, definitive plays. I do actually love a breach in sterling Kiwi here to the upside for a more prolonged long side approach. Oh, Craig, you follow up with, I heard you talking about sterling earlier, but I've been playing sterling Kiwi, both long and short, since the weekly open really well, and I'd love to snapshot your charts if you have time. Well, here you go, my man. Look, you came off of a beautiful region of support last month. It couldn't have been cleaner. Again, I talk to you guys all the time about my favorite setups. 100% extension off the high, confluence with a 618 off the low, or vice versa tend to be my favorite plays. And certainly on this pair was the exact pinpoint low before this thing saw a more significant rebound, let's say. Huge ATR. You're looking at almost 300 pips on a daily basis. So, Craig, I give you props, man. It's definitely a aggressive trade, and I love it. The only thing I don't love is sort of the range that we've been holding, both near term and long term. If you're playing this just as a range on the long and short, like you say you have, you're right on cue. I really wouldn't be looking to play a breakout trade until we get more of a definitive move in price. Let me take a zoom out here and see what we got on the near-term chart. I haven't taken a look at this recently, so let's see what we've got. All right, don't want to stress that. $21.56, or excuse me, $21.15.65 is, I believe, the yearly open, 2016 open. Yeah, that's just higher from where we are right now. It's right here. And again, that key 50% retracement just lower is at 215.12. Okay, let's just do some on the fly here for Craig, see if we got any levels. Okay, looks like a decent extension there. And one other retracement I'll want to take into account, and this is something that I kind of like to do just early in the early sessions of the year, is especially when you get a round trip like this, or if you get a more meaningful rebound like we're getting, is just a retracement of the yearly range, just the 2016 range. Come on. Come on. Sorry, I'm a little anal compulsive about getting my levels right. In any event, roughly speaking, 38.2 and 236 are void at this point. Don't want to stress those. 50 comes in right with the yearly open. That's pretty big. Okay, so the 50% retracement of the yearly range comes in line with the 2016 opens. That gives you a range of 215.58 to 215.65 as major key resistance. And actually, interestingly enough, over the course of the next 48 to 24 hours, it does coincide dead on with the median line that we just added off the low. So I'm going to highlight that near term. This is what I would like to designate as sort of my breakout zone. You got a clear-cut target to the upside if it does clear. Nice confluence resistance again, Fibonacci 1618 off the low and a 618 off the high, and that takes you into 217.73, 217.96. Would be sort of the first zone of resistance you'd look for on a breakout from that region. Near term, bullish invalidation, Craig, I'd have right there. Okay, so if we break back below that 618 extension, pretty damn close to those highs that we made a few weeks ago, but more importantly, would make and necessitate a clear break below the lower median line parallel. In my eyes, this would be the reversal play and continuation to the lower, what do you want to call it, lower bounds of the range. So if we do see that break, you'd start to move for a more concrete, you start to look for a more concrete move towards the monthly open. The monthly open comes in at 211.05. Actually, I should probably add that. That's a 214 high. Open is 211.058. Oops. There you go. And that's the monthly open. Craig, does that help? Let me zoom this out for you, and you can feel free to take a quick snapshot of the levels. I would be looking constructive above 212.03. Break of the highs, you're looking at key resistance at 215.58, 215.65, and a break there. We're really looking at that main key target up at 217.70, 217.90. Does that help? Craig says, fantastic. Thank you so much. Hey, it's my pleasure, my man. Ricardo says, hey, Mike, could you tell me the ATR for Euro Aussie? How can I get that tool? Ricardo, you can get this at fxcodebase.com. I also believe they have it on fxcmapps.com. It's called ATR Pips Indicator, and it allows you to put a percentage or a multiplier on the ATR for whatever time frame you're looking at. Now, guys, just remember that if you're putting the ATR in the 30-minute chart, make sure that you're changing the data source to the daily period. Okay, we don't want to look at the ATR of a 30-minute candle chart. Okay, that's not the ATR that we're targeting. We're targeting a quarter of the daily ATR. So make sure you put that data source to 1 day and the parameter here to a quarter. Will get you that nice little read there in the top of your charts. So much easier to find. So for Euro Oz, let me get it for you. Here's what the daily chart looks like. Testing the yearly open once again as resistance near term. Nice fat 223 pip ATR gives you a quarter of about 56 pips per scalp. So Ricardo, that's what I'd be looking for on scalp targets for the Euro Oz. Coming in some near-term resistance here. Yearly open is just higher. All right, Ricardo, hope that helps. Guys, that puts us over the time limit. You're more than welcome, my friend. Again, we will be back tomorrow. Okay, powder is dry. Thanks always for keeping my trading properly focused on track. See you tomorrow. Same to you, Eileen, and everyone in the room. Thanks for attending. Again, we'll be back on tomorrow at 8:30 Eastern. So watch for the morning tomorrow. You do get you head into some major event risk and the FOMC, and we'll give you a preview of that when the dollar crosses ahead of that release tomorrow morning. All right, guys, cheers. We'll wrap it up here. See you tomorrow.